Personal consumption expenditures, Fed's preferred, increased 2.8% year over year in February. That's before the peak of the US-Iran war. Comparing the headline versus the core, cost of goods and services like rent, healthcare, insurance, and restaurants are experiencing slightly stronger inflation. Some are saying that these are effects of tariffs. So now on top of tariffs, there's the high energy prices from Iran war. Fertilizers are also a key item that flows through Strait of Hormuz, and these will also feed the prices for farmers and then consumers. Moving to March Consumer Price Index, it increased 3.3% year on year. The increase in Consumer Price Index meant that real earnings, meaning salary after inflation, will decrease for the U.S. workers. That means purchasing power dropped. Given that consumers support 2/3 of U.S. GDP, high inflation will raise some concerns. Energy costs jumped almost 11%. Airline prices jumped. Apparel prices also jumped, which shows some signs of tariffs. Gasoline prices jumped 21.2%. But traders didn't really respond much to this because this is obviously expected and a lot has been priced in already. Next, markets expected almost no chance in rate cut. But Fed officials said that there might be one, just a small 0.25% cut this year. Look at the picture at the right. The energy portion, gasoline, electricity, and piped gas services all increased a lot. These are the year-on-year movements of prices. And then, even e-commerce sites will start to add levies. Amazon will start levying 3.5% of fuel and logistics surcharge. United Parcel Service and FedEx will also do the same for fuel surcharges. And so even if there is a complete clean deal between US and Iran and vessels start flowing through the Strait of Hormuz again, it'll take a while for things to normalize because the damage from strikes on energy infrastructure will take time to fix. Some background. There's a 2-week ceasefire between US and Iran. Iran rejected Trump's 15-point proposal and came up with their own 10-point plan. Israel supported Trump's decision to suspend strikes against Iran, but said Lebanon is not part of it. Israel recently attacked Lebanon, killing at least 180-plus people. This is because of to combat Hezbollah, the Iranian-backed paramilitary group. US and Iran recently had a failed negotiation at Pakistan. Pakistan is the key mediator. Both US and Iran appeared to be farther apart, and Iran demanded for control of Strait of Hormuz. Trump is weighing resuming military strikes. The US will start blocking maritime traffic in and out of Iran's ports, but the US will not block vessels using the strait to get to non-Iranian ports. There's some news reporting that vessels need to pay Iran tolls to move through safely, and Trump is not too happy about this. There's some talks about Asian currency declining and bringing memories of the 1997 Asian financial crisis. Firstly, because of the spike in energy costs, many governments rolled out emergency measures. In Philippines, you might see out-of-stock signages on the Shell petrol stations. But this time around, it's different because exchange rates regimes are more flexible. And more importantly, individual Asian economies have deeper foreign exchange reserves which help buffer and absorb some of the shocks. And most Asian economies have built up their US dollar reserves. Asian currencies are depreciating because of these two main reasons. High fuel costs will flow into a higher transport, electricity, manufacturing, and food-related costs. These will push inflation up and make the currency weaker. Next, investors tend to want to move money into safer and widely used currencies, which often is US dollar, and then second to that is euros. That means Asian currencies will be weaker. So what is the 1997 Asian financial crisis? Back then, Asian countries were growing very quickly, and because of fragile financial structures and supervisions, there's a sudden loss of confidence levels. Authorities stopped defending Thai baht's peg to USD, and speculative pressure then badly drained foreign exchange reserves. Countries such as Indonesia, South Korea, Malaysia, and Philippines were hit hard. Many Asian economies, back then, fixed or pegged their currencies to US dollar. So 1 unit of US dollar equals to some units of that country's local currency. The respective central bank will use its US dollar reserves to buy back its own currency whenever the local currency weakens and push it back up, or sell its own currency and buy USD to push the local currency back down. That maneuvers the supply and demand relationship between USD and local currency. That made foreign borrowing look safe. Then, many banks and companies borrowed short-term debt heavily, often in US dollar. The Asian countries' banks and companies then lend those money to their local property and construction developers and other businesses. So you see, The banks and companies need to fulfill the interest payments and short-term debt's principal payment, but they're in between the long-term debt that their local businesses need to pay back. And to make things worse, these debt were unhedged. So that brings us to the topic of the currency movements. Back then, because of the loss of confidence, currency levels dropped a lot, especially Thai baht. But the Asian banks and firms owed US dollar repayments. That means they faced much larger repayment burdens in local currency terms, which turned into a banking and corporate solvency crisis. So firstly, currency fell because export during then, especially in 1996, became very weak, and most Asian economies were having current account deficit, meaning trade and money flowed out more than inwards. In layman's terms, they spent more than they're earning, and also the service of rising external debt. And to sustain exports, currency had to be at a low, comfortable rate. The Asian currency fell also because investors' confidence level became very low and they pulled out the capital. So, this is what happened. Foreign investors lent to the Asian countries' banks and businesses in US dollar short-term debt. The Asian local banks and businesses then lent the money to their local property and construction developers and companies in local currency long-term debt. And then, the real estate landscape became a bubble. Then, exports dropped sharply. That means currency had to be at a comfortable level to sustain exports. So then, the foreign investors lost confidence and pulled out their money. The local currency dropped even more because now the capital for growth and projects is lesser. Weaker currency meant inflation levels picked up very high. The drop in local currency means the Asian local banks and businesses struggled to pay back the USD debt, hence the solvency crisis. Back then, it was a financial shock. Banks' inflows dried up, and there was a constant deficit in current accounts. But today, it's not. The equation now is the physical or supply shock, and the impact now isn't as bad as back then. Economies learned from their previous mistakes. They built up more dollar reserves. Now the next main challenge is the U.S. blockade of Strait of Hormuz, because that'll affect about 1/3 of the oil supplies needed for Asia. That's about 10 million barrels per day out of 30 million barrels needed. China's prices went up. Producer prices finally climbed out of negative region to 0.5% year-on-year. Consumer prices went up too, now at 1% year-on-year, comparing the non-core versus the core. Core basically excludes food and energy. It's quite like the U.S. goods and services face more inflation now. That means inflation is becoming structural than temporary. This is what China wants, which is different from any other country. China doesn't want to be in deflation, simply because when the residents in China know that inflation level will keep dropping, they'll keep delaying their purchase of big-ticket items and wait for the lowest price point. That'll hurt corporate profits a lot. So, the pickup in inflation is good for China, and their target is 2%. While China has the world's largest reserve in oil, that's not to say they're fully immune to the impact of high gasoline price. Gasoline prices jumped 11.1%. The government stepped in to cushion the blow. But then on a year-on-year basis, gasoline bills went up almost 3.8%. But China's better than its peers. They have the flexibility because they're starting off with low inflation figures. But if the disruption of Strait of Hormuz carries on, Morgan Stanley is forecasting that China's real GDP, after inflation, might slow to 4.2%. The recent industrial profits jumped sharply, thanks to China government's efforts to stop overcapacity and stop the price wars between companies of similar industries. But moving forward, there might be some cost-push inflation cycle because of oil prices, and manufacturers might absorb the price jump. But again, China is at a unique stance because they're starting off with low inflation numbers, and the government is very reactive in helping. The low inflation numbers also mean that keep the door opened for potential monetary easing. Lastly, Yardeni Research commented that stocks already found their bottom. That's very similar from what we went through last week on views from Morgan Stanley. And earnings will probably come in better than feared. And markets are used to buying geopolitical dips. Now that's for equities. For fixed income, inflation risk might be more serious. Inflation always erodes bonds' coupon payments because of the nature of periodic long-term payments. Next, everyone is waiting for S&P's Q1 earnings report, which will happen at April 28th. While growth has slowed a little overall, it's not broken. Many are expecting corporate earnings to still hold up well. Analysts are expecting S&P Q1 2026's earnings to rise about 14% year-on-year,